So, Miss Caroline, I know you're going to be doing this in 2 days. Before we get started on any specific questions, do you have anything that you want me to go over?
Um, Maybe a little bit of finance.
Okay, well, let's talk about finance. And let's see, I'm not going to go over everything, but let's just make sure you understand some basics. So, financing, we know, is an issue for most people. So, let's just make sure we understand. I'll throw out some words here. Oh, and Trick says, best of luck to you. We love that. How are you on understanding that an actual mortgage has two parts? You got the promissory note, which is the promise to pay, and then you either have like a deed of trust or the mortgage. Like there's the mortgage or a deed of trust. When we talk about in general, somebody's going to get a mortgage. We know they're going to give a mortgage, and we know they're going to give a piece of paper that is the promissory note. We know they're either going to give a mortgage where there's just a lien on the house, or it would be the deed of trust where they're actually transferring title. How do you feel about that? That's good?
I feel pretty good. I know that that's the common way to buy a house and finance a house,
Mm-hmm.
actually.
Exactly. And
Yeah.
even though this is for everybody, Caroline's testing, I said, hey, does she have any question on finance? But for any of you all, if you have questions about any of this, please just holla. All right. So that's what I said. Let's see what else is a big word here. Um, you understand that a promissory note is negotiable. You know what that means, yes? That it can be transferred. We're not talking about the fact that you can, try to negotiate the percentage. When you see the word negotiable, when it talks about promissory notes, we're talking about the fact that you could give it, it can be assigned to somebody else. You feel cool with that?
Yes.
Cool. Do. I know we've done a ton on the acceleration clause, the prepayment penalty, and the due on sale clause.
I'm pretty
Not
good
to
with that
mention,
too.
you got your defeasance clause. Stop that. The defeasance clause, release clause, subordination clause, and assignments of rent clause. How do you
The
feel about
defease,
those?
defeases, or however you say that clause, is the one that I get confused on.
Okay, so we know this defeasance clause is very similar, right, to a defeasible defease estate. Do you remember learning about defeasible estates?
Yes.
And in a defeasible estate, if you don't follow the rules, your ownership could end, right? Your ownership
So it's
ends.
kind of like you're being defeated because the ownership ends. Is
Well, when we're talking about mortgages, what we're saying is when you pay your note in full, when you pay in full, you want the lender's interest to end. Do you get what I'm saying there? In a defeasible state, your ownership ends if you break the rules. If we're talking about a defeasance clause, when you sign the paperwork, you say to the bank, look, you might have a lien on my property, but when I pay you in full, you need to release your interest. Your interest ends, bank, because I paid you back. So it's
okay.
all about something ending.
Yeah, that makes sense now.
Cool, cool. See, this is
Yes.
good. Mhm. All right. And again, for the people that are joining us on YouTube and coming a little later, we're just kind of doing a review on finance to help Caroline prepare, and then we'll get to some questions. But if you have questions, as always, you can ask. Are you comfortable with the difference between title theory and lien theory? Do those two words kind of make sense when I say title theory versus lien theory?
I am a little bit title theory. Um, is that between the different states? one's title theory and one's lien theory,
Yes,
or okay,
exactly. So
okay.
when you look at a map of the United States, and I can't promise this is accurate, and especially in California, y'all are all just confused at it. Y'all can basically do both. But in general, most states are either title theory or they're lien theory, and then those yellow states are intermediate theory. But if I were to sum this up, in a title theory state, and North Carolina is a title theory state. When you buy the house, you treat it like a car loan. Just like with a car loan, it's not your car until you pay it off. That car belongs to the bank until you finish paying off your car loan. You gave the bank title to your car. In a title theory state, you're giving title to the bank until you pay off the house. In a lien theory state, the borrower keeps title. They retain the title, and then there's only a lien. So I like these words because they kind of tell you what they are. It's about the bank's interest. If the bank loans you money, in exchange, are you giving them actual ownership of the house, or are you just letting the bank put a lien on the property? Lien theory, the borrower owns the house outright. There's just a lien on the property. Title theory, the borrower is literally giving title to the bank. How do we feel about that?
Got it.
Cool, 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 cool. And an intermediate theory is a mix between the two.
Yes.
Right. So whenever you're seeing this in a lien theory state, they use mortgages. Mortgages create liens on the house. In a title theory state, since you're transferring title, there is a deed of trust because we know by definition, a deed is a document that transfers title. So if you bought a house in North Carolina, you would get the deed from the seller and then you would turn around and give the bank a deed to own the property, just like with your car loan, but you still get to drive it, you still get to live in it. That is going to be title theory states. They use deeds of trust. In a lien theory state, those are people that use mortgages and they just put a lien on the property. The owner keeps title. Right? And of course, in a title theory state, there's a non-judicial foreclosure because the bank owns the property. They don't have to go to court. In states that are lien theory, where there are mortgages and the only interest the bank has is a lien, in order for the bank to foreclose because you did not pay, they would need a judge, and that would be a judicial foreclosure. Let's see, that's saying the same thing. So I don't want to get too far in the weeds. These are just huge words. It says literally, and I tell my students, I've got like 7 slides that explain the same concept. So I just want to make sure you're cool with this. And then when you go back, if you watch this again tomorrow, because it's about financing, you can look at the slide and go, okay, that makes sense. All right. Oh, look, deed of trust yet again. I'm going to skip that. All right. So we know the bank is loaning money. And if you don't make your payments, the bank can foreclose. So let's say you owe, I don't know, $300,000. You owe $300,000, but when you go to sell, you only get $250,000. The bank doesn't just flat out say, oh, don't worry about it. We don't care about those monies. No, generally, what they will do is they will file for a deficiency judgment. It's a judgment, and we know judgments are a type of encumbrance. What type of encumbrance? Oh, well, it's a lien. And what type of lien? It's a um, general lien. I had to think about it because a general lien is against a person and everything they owe. The mortgage or the deed of trust is a specific lien. because it's on one piece of property. But a general lien is against a person and everything they may own. So they sold the house. You sold it for 250, you owe 300. That $50,000 becomes a lien against you. It's not attached to your real property that you just sold. It's a lien against you, which is what all that is saying. Do do do. This is that defeasance clause that we were just talking about. It requires the lender to execute satisfaction. They've got to tell the what do you call it? The place, register of deeds. They got to tell the public, by the way, this person satisfied all of their requirements. They paid me the monies that they owed me. So now I, the bank, am letting this title go free. This is the bird. The bird is singing right here. Be free. Or actually, it says, I'm free. It's the defeasance clause is saying, bank, you let your interest go. Your interest, bank, has been defeated. It's just my house now. Let's see what else. That's a video. We know what foreclosure is, but I will say a huge point about finance is when it's sold at foreclosure, if there's any other liens still left, those would get cleared up too. So in the earlier example, I said you owe 300,000, but then you sell for 250,000. That's not what I meant to do. Do 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 boop boop. 250,000. We know you still owe 50,000. Okay. Well, even though you owe 50,000, even if this covered your loan, but you owed 50,000 in mechanics liens or something, this lien stops being specific and it becomes general. Or, like I like to say, when a house goes through foreclosure, the person who buys that auctioned foreclosure house, they're getting good, clean title. Any liens that weren't cleared with the proceeds that are brought up from the auction, we basically look at the house and said, "You're getting clean, but you're getting clean, but we're going to take that dirt and put it on you as a person. We're not going to limit your lien just to your house anymore. This money you owe is owed by you, and we're telling the world at the Register of Deeds, this person owes money," which again is why it's a general lien. So for everybody, let me just know whether it's in the chat or whatnot. Does that make sense? Because this is a huge concept that they love to test on. It's math-ish, but it's concept you need to know. If you still owe money, you still owe that money. You owe it, not the house. All right. Thanks, ladies. I'm glad that makes sense. Let's see. Types of foreclosure I talked about. Judicial foreclosure is in a lien theory state, and non-judicial foreclosure, that's in our title theory states. We know in some states you get what's called a loan redemption period. So if at the beginning of this time chart, a borrower defaults, they don't pay, eventually they're going to be sent notice of foreclosure. Somebody's going to give them a letter that says, hey, you didn't pay the bank. The bank wants to sell your property to get their money. And they will, they want to sell your property to get the money. I don't know what I was going to say there because I just saw you say, Trix, you said you'll rewatch. That is fine, Trix. You can rewatch. Or if you want me to back up and explain something again, I promise you nobody's going to be upset. It does not hurt to hear it again. So you default, and then you get notice in the mail. Oh, the bank is going to foreclose your house. You'll have some time, but then eventually it'll be sold at auction. During this time period, if you come up with the money, you will stop the loans, the foreclosure process. They'll be like, "Oh, you got your money, never mind, we're not going to foreclose on you." Because remember, banks make, and quite literally, I'm not even going to excuse my French on this one, they make a shit ton of money in interest. We've seen that math. So that they would much prefer for you to go back to paying them a lot of interest than them foreclosing, and then they can only sue you for the principal you still owe them. So between being told notice of foreclosure and the actual auction sale, right, you can be reinstated. You can have your status as a home buyer paying off a loan. You can have that reinstated. You basically say, okay, here's the money that the back mortgage payments I owe you. And they go, okay, well, you're good then. Come back to paying us every month. So before the loan is sold, we call this, or the house is auctioned, we call this the equitable right of redemption. It's before the sale. At the same time, in some states, after the sale, you have a statutory redemption, which is where the law the law says, "Oh, you know what? Even though we took a final bid here on this date, we're going to let anybody else who wants to figure this stuff out, we will let them retroactively make a bid." Right? Now, how many days you can do this for depends on your state. But after the auction sale, some states say, you know what, buyer, we'll still give you time after the final sold to the highest buyer. We will still give you time to fix this up. Right? We call that the statutory right of redemption. The idea that after the sale, the borrower who messed up still has the right to come and make this right. That's what statutory is. Equitable before the sale, statutory after the sale. And remember, these are in alphabetical order. It's an easy way to remember that. They're in alphabetical order. And also remember, just like not every marriage relationship gets a happy ending, not every state allows for statutory redemption. Statutory, it's got the word statute in it. So in the state of North Carolina, right, we have a 10-day statutory period after the sale. Right? Because our law says 10 days. It would be up to you all to figure out what your law says in your state. So I just said that the equitable right of redemption is before the sale, and the statutory right is after the sale. And notice it even goes in alphabetical order there. All right. An REO means it's a property that could be on your MLS, but it's owned by the bank. That's an REO, real estate owned by a bank. Mm. Remember, a short sale is not the same. No, it is not the same as a foreclosure. And a short sale. In a short sale, there's no I'm going to say unpaid past payments. In a short sale, let's say the seller who used to be a buyer, the seller found out 4 weeks later they're going to start a new job and make twice the money, but they have to move to California. They're selling that house. They're taking that job and they're selling the house. But if the house is you owe more than what you can sell it for today, then that would be a short sale. You owe the bank more money than it's worth. So it doesn't matter. Short sales don't mean you didn't pay, you're behind. Short sale means you need to sell it. But when you go to sell it, you're not going to have enough money to cover all of your debts. Foreclosure means you just flat out didn't pay and now they're just putting an end to it. Right? So yes, REOs, real estate owned. So REOs are real estate owned. And just to bring it back, at the end of whatever your state upset bid period is, it now belongs back to the bank. and the bank can ask an agent to put it on the market for them and sell it to normal, people, everyday people. That is what we call an REO. Right. Am I going too fast here? Let me know because this is just a really quick review, but I can slow down and explain something to anybody because I want you to pass this test. All right. Scrolling back to where we were at short sales, short sales. So at this point is a quick review. Okay, good. Thank you. I'm doing awesome. I just want to make sure it's fresh in your head. Once you understand how mortgages work, the questions that people have are, well, how much could I afford? And what type of loan should I get? So that's what we're going to talk about now. How do we find out these things that the buyer most definitely wants to know? What's this going to look like? How much am I have to pay monthly? Is this an ARM or is this a flat rate loan? Tell me what's going on. So I know that you know. I know anybody who is listening to me do any math. I know you know that you pay PITI or PITI payments, principal, interest, taxes, insurance. PITI. We know that the P&I amount, if it's going to be just a flat rate loan, you're not doing an arm or adjusting anything. If you're paying P&I, this never changes. However, the T&I is about taxes and insurance, and these tend to change annually. So when a borrower goes to figure out how much of a house can I afford, you want to remind them, oh, if you buy a condo, you're probably going to have to pay HOA stuff. You got to do that. And if you buy into like a building, you're also going to pay your share of taxes and your share of the insurance for that building. Like, it's just a lot there. PITI. But most importantly, this amount doesn't change during the life of the loan. So we know that loans are amortized. And amortized means you pay and it's going to stay the same. So you see here, this is to do based off of a 30-year mortgage. And this is the visual that's telling you, look, let's say your payment amount every month was $1,800. Well, of that $1,800, maybe $1,700 went to your insurance. And then the next month, maybe, and I'll change colors here, maybe the next month it would be, um, trying to make this clear. In the green, you have what would be going to the bank. This is basically interest. And the blue is going to be the principal. So that should be PAL. Oh, it doesn't matter which principal it is, but fine. At the beginning, most of what you pay is interest to the bank, and a little bit is to reduce how much you owe the bank. But look, as you go through time, less and less of what you're paying is going to go to the bank for interest, and more of it is going to cover your interest charges. Hopefully that makes sense to everybody. But again, if you have questions, just ask. Doot, grab some more water. Okay. We know this is a factor table. We know when you pay P&I, principal and interest, you pay a certain amount for every $1,000 that you borrow. So if you got a loan for 30 years at 8%, then you'd be paying $7.34 monthly for every 1,000 you borrow. So if you borrowed 2000K, you're going to pay 734 plus 734, which is going to be, what is that? 1468. You would pay $14.68 for 30 years at 8% interest because there you borrowed $2,000. If you borrowed $3,000, you'd be paying the 734 for another total, and so on and so on. And we know this is an amortization schedule that shows even though how much you're paying never changes, that stays the same. Our interest payment, how much goes to interest goes down, and how much goes to principal goes up. All right. And I just pulled this together just to show everybody. This was a 30-year, 5.75% loan for $350,000. And it's not until you get to payment 216, which, let me see how many, 216 months. So that's 18 years. You make payments for 18 years before at least half of what you make. Some of it is going to principal and some of it is going to interest. Look at that. You're at payment 216, 18 years before half of your PI check goes to principal, half of it goes to interest. And after that 18 years, you would have paid $303,000 in interest. You only borrowed 350. But at that point, you're not even done paying interest yet. You still have $303,000 that if you paid towards interest. If you had made that an interest-only loan, if they would give it to you, you would be close to paying it off. Instead, you still owe the bank $212,000, even though you've been paying all this money so far. You paid them. In fact, we could figure it out. If I took this payment, $2,042.19. If I multiply that by 216, there's 216 payments. Then I get in total, you would have paid 2042.19 times 216,000. Total, you would have already paid $441,113.04. That's what you total paid, but 303 of that was actually interest. So you still owe the bank $212,000. That is what we call some BS. So would it be better to do a 15-year loan? Well, yeah. If you did a 15-year loan, and this is just to understand the math, right? What would change would be this this right here, this factor table, right? So your factor would change. This was at 5.75% interest. Now, I would have to go find what this factor or rate of P&I is, which I can do because I know I have this on my computer somewhere. My files, that would be under math. This would be under finance math. And then I've got to pull up an amortization chart. So if you borrowed for 15 years at 5.75%, you'd be paying 8.30410. 8.30410. So you'd be paying 8. What did I say? Gosh darn it. 8. What is wrong with my brain? 83410. I should have said it that way. 83410. Come back here. This would be 15 years at 5.75%. So if you did that, this is your factor, and you borrowed $350,000. So I'm going to take this 8.30410 and multiply it by 350, which means your payment would be 8.30410 times 350. Your payment would be do 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 $2,906.44. So that would be your monthly PI. Instead of paying $2,042, you'd be paying $2,906.44. You're paying more in every month. However, having said that, let's use two different colors. For purple, I'm going to stick with the original right here. If you paid this amount, the 2,042.50, you paid it 360 times, you would end up paying 2042.50 times 360. You'd end up paying $735,300. And remember, you borrowed 350. So in total interest, you would have paid 385.30 or 300 over 30 years. However, let's use blue. If you did the 15 years and you paid monthly the 2906.44, well, I'm going to do the 2906.44. And then instead of 360 payments, it's only for 15 years. So if we do 12 times 15, obviously that's 180 payments. What you would pay in 15 years would be $523,159.20. You minus that 350 you actually borrowed. Uh-oh. Subtract 350, one too many zeros. That gives you paying $173,000 in interest. So would you rather pay $385,000 in interest or $173,000 in interest? That's what paying for 15 years would look like. Like you said, Caroline, in the chat in my uh, room, yeah, the payment goes higher. You're paying 2906 a month, but you're only paying $173,000 in interest over 15 years rather than paying $385,000 over 30 years, which if I take 173, multiply it by 2, you're paying more than double. Twice, if you multiply this 173, you actually would be paying 346,000. This is still 40 grand more expensive. That's crazy. So again, you all know I want you to pass the test, but more importantly, I want you, the next time you go get a car, the next time you want to refinance something, whether it's credit cards or you want to buy a house, looking and messing with, hey, you don't have to do 30 years. What if we borrowed less money, had a higher payment, but I paid so much less in interest? Or maybe I borrow the same amount of money, but I pay more monthly for 20 years and pay a lot less interest. That's why, even if you don't have the math, like in California, understanding how all of this works is so key. Even if you never practice real estate, if the only thing I ever made happen was the next time you go to get some credit, you're like, oh, silky, silky now. Y'all aren't trying to get me. I consider it a job well done. I know this is a hot mess, but you all also know I've done videos on this on my YouTube page. I don't think I've done a video that specifically was saying, hey, I'm going to start from the beginning to compare how much you pay versus two payments. But I could do that. But, you know, just lesson learned there. All right. So let's keep on going here. I know that you all know what LTV means, loan to value. We're comparing how much of the value of the house you need to borrow. So, could it be 80%? Are you borrowing 60%? Are you borrowing 90% of the value? That is LTV. We know with mortgages, they are either conventional or they're government. Conventional means the government is not helping, and government means the government is either going to insure or guarantee the loan. Did I spell guarantee right? I don't know. So it's either a conventional loan or it's a government loan. We know in conventional loans, you're probably going to have to put down at least 20% down payment. And if you do less than that, you'll have to pay PMI. You're going to have to probably have a credit score of at least 620. Conforming loan means it meets, just in case they sell it on the secondary mortgage market, Fannie Mae and Freddie Mac would buy it. And we know there's limits. They're not going to take a $1.5 million loan and buy. Nope, they're not going to do that. And a non-conforming loan means, oh, it's not one that's going to be bought by Fannie or Freddie. And a jumbo loan is when, like I said, it's too much money. The bank loaned too much money, and now Fannie or Freddie don't want to buy the loan. We know PMI has to be removed at 78% when the value of your house is at least at 22%. They must remove PMI, private mortgage insurance, and you have to put down at least 20% to not pay PMI. Let's see. We know if it's a conventional loan, no more than 28% of what you make in a month can go towards housing expenses like PITI, PMI, and HOA. And no more than 36% of what you make in a month before they take out your taxes can go towards your housing and any recurring debts. So I know in California you won't have to do that math, but in a lot of states you do have to do it. And they're going to talk about your qualifying ratios, your, 28-36. Let's look at how much money you make and bring in compared to how much money has to go out the door. Let's see. All right, let's just do this real quickly and we'll use this one. In a government-backed loan where it's insured or guaranteed by the government, we know if it's an FHA loan, the money comes from the bank. And FHA gives the mortgage insurance premium, or they're providing what we call MIP. It's still mortgage insurance, but it's mortgage insurance from the government. It's MIP. And unlike a conventional loan, if you get an FHA loan, you would be paying this forever. In a VA loan, we know it's only for veterans at first, and we know they are guaranteeing the loan. The money's still coming from the bank. The government is just telling the bank, We promise if you loan them money with that they qualify for, you won't lose a single debt, a, a single penny, a single just cent is what I was trying to say. We will guarantee you will get all of that principal back, which is why some vets do not have to put any money down. And then another type of government loan would be a USDA loan, and those are for rural areas. So that was a very quick reminder of what these different government loans are, but it's important for the test. So this is just my going through all of those things. Do, 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 do. I would encourage anybody who's watching, take a screenshot of this. This is summing up some of the major differences between the conventional loan, the FHA loan, the VA loan, and the USDA loan. You know you're going to be asked. Might as well memorize this. This piece of paper, every single one of these little dots on here, marked points, could be a test question. You need to know this stuff. Plus, if you're helping people buy residential, you should probably understand it because these are the kind of questions they'll be asking. You're not a loan officer, but without loans, most people can't buy houses. So it would help and it would behoove you if you can speak the language of loans. Oh my gosh, that would make a great CE class, wouldn't it not? Called Speaking the Language of Loans. Doesn't that sound cute? Speaking the language of loans. The other one I want to do is the lost art of loyalty. I want to do a class about agency and loyalty and obedience. I'm going to call it the lost art of loyalty. All right, cool. Let's keep on rolling. We know a purchase money mortgage is another word for seller financing. We know those are just types of loans. I already know. You all know that an amortized loan, the payment doesn't change. We know in an adjustable rate mortgage, your monthly rate changes. You have a beginning interest rate, but then it changes based on the index. It can go up and down based on what's the market doing now. All right, that's just talking about negative amortization. I mean, these are all important things, but on a day like today, I just want to make sure the big concepts are covered. Ooh, this is important. A fully amortized loan, if you look at this, this was a $10,000 loan at 8.5% interest for 10 years. And a fully amortized loan, would pay $123.99 every single time. There'd be no balloon payment. If you got an ARM or a partially amortized loan, your payments would start slow at first, but you don't pay enough to cover everything over the 10 years. So your very last payment, you might have to pay the bank $8,000 to cover what you already paid. And in a term loan, otherwise known as an interest only loan, every month you're making payments of 70.83. And then after 10 years, even though you made payments of 70.83, after 10 years, you're still going to owe them the original $10,000 you borrowed. It crazy. It crazy. Let's see. I know you all have seen this whole open-end mortgage where they can keep drawing money out from that loan. A blanket mortgage covers more than one parcel of real estate, and a package mortgage is going to be both real and personal property. When somebody assumes a mortgage, the buyer is going to become personally obligated. This is all about the buyer when they assume a loan. But if a house is bought subject to the loan, the buyer is not the one at the end of the day who's going to be held responsible. The seller might be looking and being like, sorry, seller, the original owner, you borrowed money. You thought this new person was going to pay, but they didn't. So you still owe us those other monies. Right. Um, You know, you could be tested on the Federal Reserve System. We know this is the government entity that says, hey, we want to make sure the banks have, the economy stays sound and like credit conditions are good. We could argue they're not, or they are doing a good job right now, but they're supposed to help with inflation and deflation and just make a more favorable economic climate. Ooh, let's get to it. So, one thing I need to make sure we all know is when you see the word security, that's a fancy name for stocks and bonds. A security is nothing to get excited about. It is just a fancy name for stocks and bonds, what people do at Wall Street. They play with other people's money and make guesses about what investments are going to pay off. Okay. But the way the Federal Reserve works is this chart. We know that banks have money and they make loans with that money. If there's a lot of money, then interest rates can be lower because more people can get loans. Okay. Or it could be, that they don't have a lot of money. So what they're going to do is give people higher interest rates because there's less money. And since less money is, interest rates are so high, less loans are made. In both of these cases, this affects how much the bank has to have on hand. If you have not a lot of money in the economy and high interest rates, the the Federal Reserve says, "Look, bank, we need you to have millions in your bank because what if Oprah comes a knocking? We understand times are tough for everybody, but we're going to require you to have $15 million on hand just in case Oprah wants to write a really big check." Right? You have to increase in reserve requirements when there's less money available for people to loan. The opposite is when money and things are just going too fast and costs are going too fast. That is when there's a lot of money in the economy, so they're able to offer lower interest rates because more people can get credit. And since everything's humming along, they will allow banks to lower their reserve requirements. Now, that was very simplified, but I'm hoping that makes sense. Really hoping. And if it doesn't, you can ask me or you can rewind. Yay. Okay, good, Caroline. I'm glad that makes sense. We know the discount rate when a bank borrows money from the Federal Reserve, they are charged the discount rate. Right. The federal funds rate, which I call the friend rate, if Wells Fargo loans money to Bank of America, the Federal Reserve comes in and says, "Hey, we just want to make sure everything's good here." The Federal Reserve gets involved when it's a bank to bank loan. And then we know prime rate is what, rich people get when they go to borrow money. If Oprah wants to borrow money, she is not much of a flight risk. You will find her, and more than likely she has the cash in one of her bank accounts to cover it. Boom. That's the mortgage markets. It's a Wonderful Life. I know you all have seen this before, but just to review it, banks have money that they put into making mortgage loans. Then the bank turns around and sells these to Fannie Mae. And then Fannie Mae, has money, they're giving money to the bank, and the bank takes that money, and that's what helps the borrowers borrow, which is a little bit incestuous there, but okay. When we're talking about the secondary mortgage market, because this is the primary, this is the primary. The secondary mortgage market means Fannie Mae bought these loans and they bought them at a discount. So maybe those loans were going to be worth $1.5 billion in 30 years. They might buy them today and buy them for 1.25. Well, let's just say 1 billion. They would I've got to take that back. They would do, let's say they buy it for nope, 3.5 billion. Want to make easy numbers. It's worth 1.5 billion. Wait, did I just do that right? Let me make sure my math is right. Okay, no, I did that. Rewind, Candace, pull yourself together. This is what happens when I try to math when my brain is so busy teaching CE. All right, let's try that again. They're worth $1.5 billion. That's what they're worth. But that's going to take 30 years. So what they do is they tell the bank, so it's Fannie Mae, Freddie Mac, all those. What they tell the bank is, look, it is worth 1.5 billion. We'll buy it from you now for 1 billion. We'll give you $1 billion right now. Why? Because bank, you can take your money and go invest it. But if we buy it for 1.5 million, in 30 years, we'll make that extra 500 million. That's why banks do this. Because Wells Fargo, let's say this is Wells Fargo, they could wait 30 years to get their $1.5 billion, or they could go with this process with the bank with Fannie and Freddie, and 6 months later, they would get their $1 billion back. And so they're like, I'd rather have money now than wait. And of course, if Fannie Mae does this, they'll make 500 million just by being patient. And that's what investors buy into. They buy into getting these monies by waiting, or they're playing what I call the long game. You invest early in these mortgage-backed securities, then you're going to eventually get your portion of this money that's coming in. Whew. All right. That's talking about primary, secondary mortgages. Oh, that's something I did earlier. I was like, that's not just what I wrote. Those are different colors. That's because I have that in my slides multiple times. You need to know that Fannie Mae stands for Federal National Mortgage Association, FNMA. You got Ginnie Mae, the Government National Mortgage Association, or GNMA. And then you got Freddie Mac, which stands for Federal Home Loan Mortgage Corporation. But basically, it's Fannie and Freddie that do the most buying. Right? This is all that stuff. Yay. This is just stuff about loans. And then to finish this up, we know when somebody gets loans, there's a process, and they have to get a loan estimate within 3 days of applying for the loan. And we know at least 3 days beforehand, they need to get a copy of their closing disclosure. And that is because of TRID. Whew. So I just spent an hour. I didn't go into much detail. It was only an hour. But Miss Caroline, do you think that's going to help you as you're studying in the next 48 hours to pass this test?
Yes, thank you so much for this.
Oh, you are so very welcome. I'm hoping this helped everybody, and I want you to pass, but I also know if you have a bad day and you don't, we'll just keep doing this until you do. We will keep doing this. But if you understood the majority of what I said tonight, then you should be just fine. I went over the big concepts. You understand those concepts, there's more than likely you'll be able to pass 90% of the finance questions they ask you. All right.
I understand most of it. So
Good.
I think I'm praying. So,
I want you to have faith in yourself and everybody that's here with you, and even the people that watch these later. We're all with you. Just imagine our heads, where our voices are in your head telling you how wonderful you are. You got this.
thank you
You
guys
got
so much.
You're welcome. So I won't be here tomorrow. I did this today because I will be in the midst of teaching.
Good job, good job. Good job, good job. T-double-O-D-J-O-B, good job, good job.